How's it? And welcome to this episode of part 3 of the Expat series. I've titled this The Change That Nobody Likes, and the main reason is before the change, if you were employed to work outside of South Africa, the income is completely tax exempt. But as we can see, the old section 1010 showed that there's a full exemption if you make the day's requirement. I go over that in part 2. And then the new one changes that the section 1010 exemption, only the first R1,000,000 is exempt. The first million is quite a lot of money, but the first million is in rands, which means that people are often paid in dollars or in pounds. That means that this amount is reached quicker, which means that basically a lot of the money is going to be taxed. And just for you who don't know what I refer to or to what an exemption is, an exemption, I wrote some definitions down here. A definition of exemption is it's excluded from a tax. So if there's an input, if there's an income tax exclusion, it means that it's excluded from that tax. If there's a VAT exclusion, it is excluded from VAT. Okay, so an example is, let's say I work in Angola, for example, and I normally earn, my contract says I'm going to earn 2 million for the work that I'm doing outside of South Africa, foreign employment, 2 million into my gross income. Then there's the section 1010 exemption. Before the 1st of March 2020, that exemption is fully exempt, so the first 2 million is exempt. That gives me a taxable income of 0 and then no tax. However, if I'm now going to go to Angola again from the 1st of March 2020, the same amount gross income, 2 million rand foreign employment goes in, but the section 1010 exemption is only 1 million. So it is limited by that 1 million. So 2 million minus 1 million gives me a taxable income of 1 million. We work out the tax on the table. So the taxable income is what you calculate the tax on. Some people get this calculation wrong, but very simply, you work out the income minus the limitation. That gives you the taxable income plus any other taxable income you might have, and you work out the tax on that. And for the 2000 I worked this out with I think it's the 2021 tax bracket, just make sure. But the tax on that, you can see, is 327,000 compared to 0. And that is why I say it's a change that nobody likes. Because let's say, for example, you work in a country where there is no income tax that you pay on their income, like for example, the UAE. The income tax is 0. That means that you go from paying no tax in the UAE, no tax in South Africa, to a point where you pay no tax in the UAE and you have to pay this completely in South Africa. The difference is with countries where you do pay some income tax is that you can get tax credits that you can use to reduce this amount. And so foreign tax credits, income tax that you pay in other countries, due to the double taxation agreement, you can use that tax that you've paid, deduct it from that, you will calculate that on your assessment, and then you have to pay the difference in income tax. Right, so that is the example. And now, thirdly, we're going to go quickly over the consequence of breaking tax residency. And the big consequence of that is found in section 9H2 of the Income Tax Act. And I'm dealing specifically here with individuals, natural persons. And the tax consequence is there's a deemed disposal of assets at market value. Now that is a lot to take in. What does deemed disposal mean? Deemed means it is considered a disposal, and disposal means it's sold or get rid of. So you are considered to have sold or you got rid of assets at market value. and that is capital gains tax. Obviously, capital gains tax has personal use assets that's excluded. So for example, a car, maybe a small boat, maybe a piece of artwork, that is personal use assets and don't fall within the ambit of capital gains tax. But that do fall into that is property and shares. Those are the two biggest or most common assets that individuals hold. But as you can see here, this deemed disposal of assets excludes immovable property. It excludes your house or any rental properties you might own. So the main asset that actually falls into that category is specifically shares, and it's a deemed sale at market value on the day that you leave the country, and that is the big big tax consequence if you break tax residency in South Africa. So you can't just break tax residency and think there's no tax consequences. There are definitely tax consequences of doing so. If you don't have assets that would fall into this deemed disposal, then you are fine. So that is the end of the video. I hope you found that helpful. In part 4, I'm going to go over the specific ways of breaking tax residency and showing some examples. I just want to say thank you for Humpo for sponsoring me with this t-shirt. His company is called T's and G's. The link is in the description if you want to check them out. The shirts are made in Cape Town and I think they're really cool. Give this video a like, maybe consider subscribing, because I think educating yourself about the tax system in South Africa is very important. Thank you for sticking around. I hope that you found this useful. Cheers.